What's up, guys? This is Andrew with the Dinsky team here at KW in Sherman Oaks. I just want to talk a little bit today about residential real estate rental property here in Los Angeles. The way I used to always evaluate a rental property is that it was really important to know that I reach what's called the 1% rule. This is a strategy that I used in 2012, 13, and beyond when I started purchasing rental real estate myself. And that is, I want to achieve 1% of the property's value per month in rent. And what that means is if you're buying a property for $300,000, you want to achieve as close as possible to $3,000 a month in rent, 1% of the value of the property. If you're buying a property for $500,000, you want to achieve as close as you can to $5,000 a month in rent. For $1 million, you want to be able to achieve as close as possible to $10,000 a month in rent. Now, here in LA, when the market was depressed in 2008, 2009, 2010, 11, and 12, rental real estate, in my opinion, a much, much better deal. We were actually able to achieve, myself and other investors that I worked with, actually able to purchase property and get very, very close to 1% per month in rent. So what does this look like? A property that was worth $200,000, we were able to get close to $2,000 a month in rent. What that means is the property is going to create a lot more cash flow per month when you purchase it. So meaning when you have your tenant paying their rent, after all expenses, you're still able to get nice cash flow each month. Here in LA right now, I call it a 0.4% rule. So if you're buying a property for $300,000, 0.4% is roughly $1,200 a month, as opposed to the 1% rule of $3,000 a month. If you're buying a property for $500,000, 0.4% will get you about $2,000 a month, whereas it used to be $5,000 a month. $1 million property is getting you about $4,000 a month in rent, where it used to be closer to $10,000 a month. What does this mean? You know, for myself and a lot of my other clients that I work with, I'm advising it's time to take some chips off the table and invest in other markets in the country where you can get closer to a 1% rule. So now in LA, properties that were purchased back in 2009, 10, 11, 12, even up to say 3-4 years ago, have seen a nice run up in price. It's a great opportunity to exchange property into another market, whether that be North Carolina, parts of Florida, potentially Texas. There's a lot of places in the United States that you can get much better returns on your investment. So in recap, looking for that 1% rule is really important, or as close as possible. I think 1% is still difficult to achieve in a lot of other markets in the country, but you can certainly get closer to 0.8, 0.9%, whereas here in LA, I feel we're very close to a top of the market. Of course, you're never really knowing exactly when you're at the top, but it seems like for a lot of good reasons, it's time to start selling, take some money off the table, and trade into another marketplace. That's it. Hope you enjoyed. If you have any questions or comments, I'd love to hear from you below. Thank you.